Hello and welcome back to the Success Guide. Having an excellent credit score can save you a lot of money in interest over time. If your score is already in the 700s, you're in good shape, but you may be wondering how to take your score from good to great, and is it worth the effort? You probably already know that your credit score is a 3-digit number based on the information in your credit report, which includes items like your loan payment history and credit card balances. Generally speaking, a higher credit score can translate to cost savings, perks, and more. Your credit score is a key factor considered by lenders, so a better score can help you get more credit at attractive interest rates, which can save you hundreds or even thousands in interest over time. Landlords and employees can also check your credit score as part of their due diligence process. And some of the best reward credit cards are only available to those with the highest scores. So how high should you aim? Getting a perfect score is extremely difficult, so many credit overachievers strive for a score in the highest 700s or over 800. That puts you squarely in the highest range for most credit scoring models. Today we're going to be talking about how to get a perfect credit score for $0. Make sure you subscribe to the channel and turn notices on so you don't miss any valuable content. Number 1, pay your bills on time. This probably goes without saying, but the most important factor of your credit score is your payment history. Though there is a precise scoring formula, a closely guarded secret, it is reported that about 35% of your score is derived from your payment history. If you have a number of late payments and/or collections, your credit score will take it on the chin. To stay on top of your payments, set up calendar reminder or enroll in automatic payments. The on-time payment goal applies to all your bills, including utilities, rent, and cell phone service. Yet, even if you have an occasional late payment, it's often worthwhile to request that your lender forgive a late payment, assuming you've made your payment and are now current on your account. Most people aren't perfect, and we miss payments from time to time. For lenders, it's often cheaper to bend a bit with customers they like to hang on to than spend a lot of trying to acquire new ones. What if you were late on a payment a few years ago? While late or missed payments, known as delinquencies, can stay on your credit report for 7 years, the impact on your credit score decreases over time. Most negative items have little impact on your score after 2 years, so be patient, keep making timely payments, and you'll soon be on your way to an excellent credit score. Number 2, optimize your credit utilization ratio. Credit utilization is another key piece of your credit score puzzle. Credit utilization measures the balances you owe on your credit cards relative to your card's credit limits. It's calculated on an overall basis, total balance on all cards divided by sum of credit limits. The general rule of thumb with credit utilization is to stay below 30%. This applies to each individual card, your total credit utilization ratio. Strategies for improving your credit utilization ratio focuses on reducing the numerator, shrinking the balances owed, and managing the denominator, maintaining or increasing the amount of credit available. Try one of these techniques to improve your credit utilization ratio. Pay more than the monthly minimum to decrease your credit card balances. Leave cards open after paying them off. You'll reduce your overall balance owed, but maintain the total limit, thereby lowering your credit utilization ratio. Request a credit limit increase on one or more of your cards, but resist the temptation to spend more as a result. Remember, this may result in a hard inquiry, which can temporarily lower your score a little. Refinance high interest rate credit cards with a personal loan that has more beneficial terms. Consolidating multiple credit card balances into one, ideally lower interest rate loan, can reduce the amount of interest you owe, which means you'll pay more towards principal and can pay off your debt faster. Plus, if your credit card remains open after transferring the balance to a personal loan, your credit utilization ratio goes down. 3. Length of credit card history. This just means the longer you've had credit for, the sooner you start, the better. When it comes to your credit score, age is more than just a number. The length of credit history has a direct effect on your is better for your credit score. You're a much better candidate for credit cards and loans when you've had credit for a long period of time, and if that long credit history is positive. Whether you've had credit for 6 months or 20 years can make a big difference in your credit score. A long track record without any major slip-ups suggests that your credit behavior will be similar in the future, and lenders and credit card issuers like that. This is one of the reasons we recommend people begin building their credit score as early as they possibly can, even if it means going and getting a credit card the day they turn 18. This will help build the foundation of your entire credit history very early on. Now, it is most important to remind you that this is calculated as the average length of your credit history, not the total length. So our recommendation is to first start building your credit as soon as possibly can and keep those accounts open and in good standing for as long as possible. This will help you build up a solid fortress of long-standing credit history so that when you do apply for new lines of credit, it won't reduce your average account age as much and it will have less of an impact on your score. Having a young credit age doesn't mean you can't get a good credit score. Payment history and level of debt have a bigger impact on your credit score than the length of credit history. If you're responsible with your credit card payments and keep your debt at a reasonable level, you can achieve a high credit score. Number 4, total number of credit lines. It would be easy to fill up a wallet with just credit cards. A card to maximize airline miles. A card targeted at your favorite hotel chain. A card that gives you cash back on groceries. Even a card that earns you points when you spend at NFL games. So, where to begin and where to end? First, the more credit lines you have, the higher your credit limit, which lowers your overall utilization and helps you score. Second, by having more credit available to you, you're able to show even more on-time payments, which again will help increase your score. And third, having a mix of credit types like an auto loan, a mortgage and credit cards shows lenders that you can appropriately handle multiple types of loans without defaulting on them. While payment history and total debt provide the biggest influence on credit scores, credit diversity and utilization serve as secondary factors. Credit mix means that a person has multiple forms of debt and/or loans. For example, someone with a home mortgage, student loans, credit cards, and an auto loan would have a very diverse assortment of credit. Credit utilization ratios reflect the total percent of available credit that a person has assessed. Additional credit cards have relevance for both of these conditions. More credit cards not only diversify your accessible credit, they also lower your credit utilization ratio through an increase in available credit. Experts say the number of cards one should have varies according to individuals and circumstance. Generally speaking, there is no one perfect number, says Ethan Dorhelm, a vice president and former principal scientist for FICO, a data analyst company behind the credit score most often used by lenders. So whether you have 2 or 20 cards doesn't really matter. What's important is that your cards give you access to more than one network and offer you the rewards that best meets your needs, which can change over your lifetime. And of course, you need to be sure you're not juggling so many cards that you can't keep track of all the payment due dates. The whole point of having 2 or 20 more credit cards is earning points or cash back on your everyday spending that you pay off every month. All the while, keep your credit utilization low so that your credit score climbs high. Number 5, number of credit inquiries. Credit inquiries can have an effect on your credit score, but not all inquiries are the same and it's important to know the difference. Soft inquiry. An example of a soft inquiry, you interview for a job and your potential employer pulled your credit report as part of its screening process. This type of inquiry will not affect your credit score. Hard inquiry. An example of a hard inquiry, you contact your credit card issuer and request a credit line increase. The company pulls your credit report to help evaluate the risk of approving your request. This type of inquiry will affect your credit score. If you're trying to open several credit accounts in a short period of time, like a credit card, mortgage, and car loan, your credit score will likely go down. When you apply for credit, you authorize those lenders to ask or inquire for a copy of your credit report from a credit bureau. When you later check your credit report, you may notice that their credit inquiries are listed. When the information in your credit report indicates that you have been applying for multiple new credit lines in a short period of time, as opposed to rate shopping for a single loan which is handled differently, your scores can be lower as a result. If you apply for several credit cards within a short period of time, multiple inquiries will appear on your report. Looking for new credit can equate with higher risk, but most credit scores are not affected by multiple inquiries from auto, mortgage, or student loan lenders within a short period of time. Typically, these are treated as a single inquiry and will have little impact on your credit scores. The impact from applying for credit will vary from person to person based on their unique credit histories. In addition to that, if you are out there getting new credit cards, that also will lower your average credit length, which could further drop your score as well. While you are here, go ahead and click on one of these 2 videos on your screen. See you there.